Hi, and welcome to the latest edition of the JMI Wealth monthly video series, and it's certainly been a very eventful start to 2023. Look, before we start to talk about financial markets and investment views, if out there you've been adversely affected by the Auckland Anniversary Day floods or by Cyclone Gabrielle, our thoughts are with you. It's a tough time. The month of February has served up a stark reminder that we aren't out of the inflation woods just yet. And in a nutshell, we've seen that reversal of the share market rises we saw in January, and likewise a lift in longer term wholesale interest rates. Now, the catalyst for the change in direction of market sentiment wasn't hard to find, and in contrast to concerns about the strength of economic activity that were prevalent as we closed out 2022 and welcomed 2023 in February, we saw indications of stronger than expected economic activity. And in the US particularly, central bankers made the most of their opportunities to leave us in no doubt that they were not going to ease off the monetary policy pedal until there is far greater certainty that inflation is under control. In testimony to US government officials in early March, US Federal Reserve Bank Governor Jerome Powell talked about potentially moving back to a 50 basis point hike in the Fed funds rate, having recently shifted to a lower 25 basis point move. But he also suggested that the peak in the Fed funds rate could be higher than previously expected. And just looking at the local context, here in New Zealand, we just keep getting economic data that suggests we aren't seeing the moderation in demand yet that the Reserve Bank of New Zealand would like to see. And just in terms of real numbers, the Reserve Bank of New Zealand has indicated that the peak in the official cash rate will be 5.5%. Local financial markets, though, have been a bit dismissive of this, and on a reasonably continuous basis have been pricing in a lower peak and an earlier commencement of interest rate cuts. But this has changed. Market pricing now tends to align with the central bank projections, although still predicting a faster and earlier decline in the OCR. In the US, market pricing is now putting the peak in the Fed funds rate above 5.5%. What is a key consideration, though, is not only the peak in cash rates around the world, but also the length of time that monetary policy will have to lean against inflation pressures. Now, in the days leading up to recording this video, we've seen a US bank get into financial difficulties. Silicon Valley Bank provided financial services primarily to the tech sector, and in early March, it experienced a run on its funds, which has led to the bank being taken over by US authorities. As we record this video, those authorities are working with the bank and looking at options which include looking for another owner for the bank or a controlled and orderly liquidation of available assets. Now, this bank was a little unusual in that it had a very low percentage of retail clients. While it's early days, initial observations are that this is quite a different situation from the bank problems that preceded the global financial crisis. Managing investment portfolios continues to be very challenging. 2022 was very much an outlier year for financial market returns. Those negative returns we saw for fixed income products being at a level that we haven't seen in decades, with interest rates normalizing at an unprecedented pace. The outcome, though, is that we do now have a more typical environment with fixed interest markets or yields now far better placed to provide diversification benefits with higher nominal yields. Now, we generally have been cautiously positioned with our model portfolios with exposure to share market assets at levels below our long-term strategic asset positions. Right now, we're really comfortable holding those positions, but we're also conscious that companies with strong balance sheets, experienced management teams, and good franchises will over time deliver attractive returns to investors. And financial markets will anticipate, as we saw in January, the point at which inflation starts to moderate and central bankers can ease off the interest rate pressure. But we know these have been unsettling times. Through that, though, the rationale for having a diversified portfolio of good quality financial assets still holds true. And we believe that now more than ever, there is value in having access to an experienced financial advisor. So look, don't hesitate to contact us. We welcome the chance to talk through some of these current market issues with you. And if you're not a client and want to get hold of us, why don't you go to www.jmiwealth.co.nz. You'll find all our contact details there.